So what if what if you're mining cryptocurrency? How does that work?
Yeah, so we're hearing a lot about that as well. And forgive me, I don't know a whole lot about what mining cryptocurrency means.
Apparently it's a thing.
It's a thing.
Hey guys, Ray and Andrew here with another weekly video, and today we're going to talk about cryptocurrency and how the IRS treats cryptocurrency. So Ray, what can you tell us about this new way of exchanging money?
Yeah, so a lot of talk about cryptocurrency, especially with the explosion of Bitcoin. One thing to keep in mind is the IRS treats cryptocurrency as a capital asset, right? So when you buy a Bitcoin or Ethereum or anything like that, there's not a taxable event there, right? But what you are doing is you're establishing your basis. A taxable event actually occurs when you either sell cryptocurrency, trade cryptocurrency, exchange it for goods or services, or receive it for goods and services. But it's very important to understand that this is a capital asset. Now, with cryptocurrency, when you buy it, you are establishing what's called your basis, right? So if you pay, let's say, $100 for a cryptocurrency, that establishes your basis at $100.
Okay.
Now, when you go to sell that cryptocurrency, you're going to have potentially a gain based on whatever the increase in value of that cryptocurrency is. It's very important to understand, because it's a capital asset, you're going to be taxed based on how long you held that, right? So if you held it a year or less, you're looking at what's called short-term capital gains. And short-term capital gains, you're taxed at your ordinary income tax rate. Now, if you hold that cryptocurrency and sell it a year or greater, you're going to get the more advantageous long-term capital gain rates, which is what most people want. So it's very important to understand that the concept of basis, what you paid for it, how long you held it, which is going to establish whether it's short-term or long-term capital gain, and then also your sales price. Make sure you know the sales price at which you sold it. The difference between your basis, what you paid for it, and what you sold it for is going to be your capital gain. Now, whether it's short-term or long-term depends on how long you held it. Now, let's say you do sell it for a loss. Let's say you don't make a gain. Well, then you'll experience what's called a long-term capital loss. A capital loss. It could be short-term or long-term, again, based on how long you held it. The thing about capital losses is that they do offset capital gains. So you do want to try to time any capital losses with capital gains, because they will absorb any capital gains. Now, let's say you don't have any capital gains, and let's say you have a $10,000 capital loss. Well, you're only going to be able to take, the IRS only allows you to take $3,000 in capital losses. Now, you don't lose the remaining, so if you do 10,000 loss and you get to use 3,000, you don't lose that other 7. It carries forward in every year until you absorb it, but you only get to take 3,000. So it's a problem if you have a $300,000 capital loss and no capital gains. You got to work down that $300,000 a year. So understand capital gains and capital losses and how they work, and you want to try to time them so that they offset.
So what if what if you're mining cryptocurrency? How does that work?
Yeah, so we're hearing a lot about that as well. And forgive me, I don't know a whole lot about what mining cryptocurrency means.
Apparently it's a thing.
It's a thing. But from what I understand, you actually have PCs that are working to mine it, and then you receive cryptocurrency for those mining activities. Well, whenever you receive cryptocurrency from mining activities, it's ordinary business income, right? Just like if you own a business, you received income, it's going to be subject to ordinary income tax rates and potentially self-employment tax as well. So mining activities will create ordinary business income. If you receive it for goods and services, if you those things right there will result in you having to pay ordinary income tax and potentially self-employment tax as well.
Hey guys, before we continue, please subscribe to our YouTube channel if you find these videos helpful. We put these out every week, and in an effort to try to help you guys out with your taxes. All right, let's get back to the show. So if I'm running my business and I receive cryptocurrency for payment for a good or service, and I do not immediately sell that cryptocurrency, and I hold it for a long term.
Yes, so you've got two potential issues here, right? One, when you receive it for goods or services, you immediately got to recognize ordinary business income. Now, if you just hold on to that coin or hold on to that currency and then sell it a year later, well, now you have you have capital gain as well.
Okay.
So you've got two tax events. You've got an ordinary income tax that happened when you received it, and then you've got a capital gain event when you sold it. So very important to understand all of these different scenarios in which you're going to owe taxes on your cryptocurrency. We tell our clients to be very diligent in keeping record keeping. Make sure you understand the date that you received it, how much, what the value was on that date, because with mining and with receiving it for goods or services, it's valued on the date in which you receive it. So make sure you keep records as far as the date, the value on the date in which you received it, the date that you sold it, the value on the date that you sold it. Make sure you keep really good records on all of that.
Yeah.
And then we can definitely help you with the taxes.
Yeah, it's definitely something that we're hearing more and more about every
Yes.
year. So we're going to be seeing a lot of that, I'm sure, in the next few years. So Ray, I appreciate you going through that with us.
Absolutely.